Hello and welcome to Chepi Today. My name is Will and I'll be going through some of the most talked about topics in crypto. If you want to be kept up to date with the discussion, give a like and remember to subscribe. So yesterday marked the day that the global cryptocurrency market cap reached $836 billion. That was its all-time high back in January 2018. This was more than Amazon's current market cap, which is just shy of $800 billion, and Apple's market cap, which is just above $700 billion. Today, crypto's market cap is just slightly less than that, at $135 billion. That is a loss of 83%, or it's a damn cheap price to buy cryptocurrencies, because this is a drop in the ocean compared to some of the market cap losses of the aforementioned traditional companies. For example, recently Apple lost the equivalent of Bitcoin's entire market cap in just one day. In fact, in the last 3 months, Apple is reportedly down $460 billion. I saw a post the other day that had been making the rounds that kind of lifted my spirits. It pointed out one by one Bitcoin's yearly lows from 2010. And while they seemed depressing in the year they occurred, it actually showed a much bigger picture of the overall market growth. If that wasn't enough to convince you we're on the right path, just remember this guy every time you have doubts.
Time to say goodbye.
So next we move on to the biggest news of the week so far, and possibly this year. Not that that's saying much really, it's still early days. But Ethereum Classic was hit by a 51% attack, totaling 88,500 ETC. Apparently Coinbase was the first one to spot that something was up, after detecting a reorganization of the ETH Classic blockchain. So Coinbase took decisive action and put a pause on all transactions. The ETH Classic mining team responded, as you'd hope they would, urging both exchanges and mining pools to increase the confirmation time. And increasing these confirmation times makes it harder for the attacker, because the more confirmation, the larger number of blocks the attacker needs to rewrite. As the number of blocks requiring rewriting increases, so does the hash power needed to continue the attack. So a 51% attack typically occurs when a single miner or an entire pool control more resources than anyone else on the network. The bad actor can then rewrite history, so to speak, or rather the history of the previous block. Ironically, back in May last year, researchers estimated that a 51% attack on the Ethereum Classic network would average a cost of 70 million. While this is obviously expensive, it was calculated that a profit from this attack could potentially yield around 1 billion USD. These kind of attacks are pretty scary, not just for the cryptocurrency that's been targeted, but for the entire cryptocurrency ecosystem. 51% attacks have acted as a quasi-Achilles heel for cryptocurrencies and pretty much completely oppose everything that decentralized tech stands for. Another scary thought is that the presumed cost of this attack still didn't deter the attacker. One solution could be proof of stake, because the algorithm requires the mining node to stake its own cryptocurrencies, which they'd risk losing if found to be malicious. Although, as we've learned, expense doesn't always deter. Another solution was suggested by Vitalik Buterin, which offered up to 99% assurance that the attack couldn't occur, requiring just 1% of the nodes to be honest, meaning that attackers would have to be in control of over 99% of the network. The algorithm that Buterin explained was designed to detect anomalies produced during double spends. Of course, this isn't without its faults, but it seems to be one of the procedures that could potentially avoid these kind of attacks in the future. So next up we have the surprising launch of the DX Exchange, which went live yesterday. The platform promises to tokenize Tesla, Apple, Facebook, and several other NASDAQ traded stocks. These will be represented by ERC20 tokens on the Ethereum blockchain, which will be backed by real-world stocks. The exchange also allows trading of cryptocurrencies alongside these tokenized securities, using Bitcoin and Ethereum as a base, paired up with Litecoin, Enigma, XRP, and Cardano. This is actually pretty exciting and interesting. It could potentially drive adoption further by opening up the market to a new demographic of investor. On top of this, there have been many notions of tokenizing the world and putting nearly everything on the blockchain to be traded or at least tracked. And it appears now that we're actually finally getting a glimpse of that. Starting with tokenized securities makes complete sense, and it's a surprise that it hasn't been done or implemented in this kind of way before. Tokenizing these stocks removes the middleman, i.e. everyone's favourite person, the banker. Look at him with his little hat on there. But the removal of these middlemen isn't simply vindictive, it will reduce the fees that the middleman takes. So on top of this, blockchain integration could enable faster transactions, and it will foster further exposure of the free market, enabling anyone with an internet connection to get involved. But as always, we'd love to hear your take on the stories discussed. What do you think about the 51% attack on the ETH Classic network? Do you think tokenizing the world is a good thing or a bad thing? So leave a comment, leave a like, subscribe, and we'll see you next time.